Most traders are not losing because they lack information. They are losing because they are fighting the market from the wrong angle. They stare at the smallest movements, react to every fluctuation, and then wonder why their decisions feel chaotic. They are not trading the market. They are wrestling their own impatience. The market does not punish traders randomly. It punishes those who refuse to see the bigger structure. Those who insist on acting before understanding. Those who confuse speed with skill and activity with progress. There was a time when I believed the smallest time frame held the answers. I watched every tick as if it mattered. I reacted instead of planned. And every reaction carried emotion. Fear when price moved against me. Greed when it moved in my favor. Exhaustion when nothing made sense. That approach did not fail because the market was difficult. It failed because my perspective was broken. Trading becomes destructive when you look too close and think too small. The smaller the time frame, the louder your emotions become. Noise starts to look like opportunity. Random movement feels urgent, and discipline collapses under the pressure of constant decision-making. The market is not designed to reward speed. It rewards alignment. Alignment between structure and execution. Alignment between patience and timing. Alignment between the higher picture and the lower decision. Top-down analysis is not a technique. It is a mindset. It forces you to slow down. It forces you to respect context. It reminds you that no trade exists in isolation. Every move belongs to a larger story, and if you ignore that story, you will always feel late, confused, and reactive. Most traders lose discipline because they are trading blind. Not blind to price, but blind to structure. They enter without knowing where they are. They exit without knowing why. And when losses arrive, they blame execution instead of perspective. The market does not need to be conquered. It needs to be understood. An understanding starts from the top, not the bottom, if you are tired of chasing moves that already happened, tired of overtrading out of frustration, tired of feeling strong before the trade and weak during it. Then this is where your thinking must change, because the truth is simple and uncomfortable. The market is not your enemy. Your impatience is, your need for action is, your refusal to step back is. Once you learn to see the market from the top down, trading stops feeling like chaos. It becomes quieter, slower, more deliberate. And that is where real control begins. Perspective controls behavior, and behavior controls results. That chain is absolute in trading, whether people accept it or not. Most traders believe their problems come from bad entries or bad strategies. They do not. Their problems come from the way they see the market. Perspective decides what feels urgent, what feels dangerous, and what feels necessary. When your perspective is narrow, your behavior becomes frantic. When your perspective is wide, your behavior becomes controlled. A trader staring only at small movements is forced into constant decision-making. Every candle feels like a signal. Every pullback feels like a threat. Every pause feels like a missed opportunity. That environment trains the mind to react instead of think. Reaction is not intelligence. It is survival instinct, and survival instinct has no place in disciplined trading. When perspective is wrong, discipline feels impossible. You can know all the rules in the world and still break them if your perspective keeps triggering fear and urgency. This is why willpower fails so often. Traders try to force discipline while looking at the market in a way that destroys. Discipline, a higher perspective, changes behavior automatically. When you understand where price is in the larger structure, small movements lose their power over you. Noise becomes irrelevant. Urgency fades. You stop feeling hunted by every fluctuation. You start waiting instead of reacting. This is not about becoming passive. It is about becoming selective. Selection requires perspective. Without it, every option looks equally important. And when everything looks important, you act too often. Traders with poor perspective trade more, not because there are more opportunities, but because they feel lost. Loss creates movement. Movement creates more loss. That cycle continues until capital or confidence breaks. Perspective is what tells you when nothing needs to be done. That skill alone saves more money than most strategies ever will. Most traders never learn it because doing nothing feels wrong when their perspective is narrow. They equate activity with control. It is a dangerous illusion. When perspective expands, behavior slows down. Decisions become fewer but heavier. Trades are taken with intention instead of impulse. Losses are accepted faster because they are understood within context. Wins are held longer because they are trusted. The market does not change when your perspective changes. You do, and that change is everything. Poor perspective creates emotional behavior. Emotional behavior creates inconsistent results. Inconsistent results destroy confidence, and destroyed confidence leads to more emotional behavior. That loop ends only when perspective is corrected. Correct perspective does not make trading easy. It makes it manageable. It removes unnecessary pressure. It replaces urgency with patience. It replaces reaction with observation. Most traders are not undisciplined by nature. They are overwhelmed by perspective that is too small. They are fighting a battle they do not understand from a position they cannot defend. When you control perspective, you control behavior. When you control behavior, results stabilize. And once results stabilize, confidence grows naturally, not emotionally. That is why perspective is not a technical choice. It is a psychological foundation. Get it wrong and no amount of discipline will save you. Get it right, and discipline stops feeling forced. Discipline is stronger than confidence, because confidence depends on outcomes and discipline survives them. Most traders believe confidence is what carries them through the market. They think if they just feel more certain, more sure, more aligned, their results will improve. That belief quietly destroys accounts. Confidence rises and falls with wins and losses. Discipline does not. Discipline operates when confidence disappears. Confidence feels powerful, but it is unstable. It grows quickly after a few good trades and collapses just as quickly after a drawdown. Discipline grows slowly and rarely feels exciting. That is why most people chase confidence and neglect discipline. And that is why most people never become consistent. When confidence is high, traders loosen rules. They size up. They trade more frequently. They justify decisions they would normally reject. Confidence whispers that this time is different, that you see something others don't, that rules are flexible when you are in sync. The market waits patiently for that moment. Discipline does not negotiate. It does not care how good you feel or how bad you feel. It demands the same behavior in both states. That is why it is uncomfortable. It removes emotional freedom. It forces consistency when the mind wants exception. Most trading mistakes are not made in moments of fear. They are made in moments of confidence. Fear often causes hesitation. Confidence causes overreach, and overreach is far more expensive. Discipline protects you from your best moods as much as your worst ones. It prevents you from trading when excitement clouds judgment. It prevents you from forcing recovery when frustration takes over. It acts as a barrier between impulse and action. Traders often say they lost confidence. After a series of losses, what they actually lost was discipline. They stopped following rules. They stopped waiting. They stopped sizing correctly. Confidence did not leave them. Structure did. Discipline is built in quiet moments. When you follow your plan even though nothing happened. When you stop trading after reaching your limit. When you accept a small loss without trying to win it back. Those moments feel insignificant. They are not. They shape behavior. Confidence is emotional. Discipline is mechanical. Emotions fluctuate. Mechanics repeat. The market rewards repetition, not feeling. A disciplined trader can operate while uncertain. A confident trader without discipline collapses under pressure. Pressure is guaranteed in trading. Confidence is not. Discipline turns trading into a process instead of a performance. You stop trying to prove something. You stop needing validation from the market. You execute, observe, and move on. The strongest edge in trading is not prediction. It is behavioral stability. Discipline creates that stability. Confidence cannot. When discipline is present, confidence becomes irrelevant. You no longer need to feel ready. You only need to be prepared. And preparation is measurable. Feelings are not. In the end, confidence wants reward. Discipline wants survival. And in this business, survival always comes first. Waiting is strategic, not passive. And until a trader understands that distinction, waiting will always feel like weakness instead of power. Most traders associate waiting with fear. They believe if they are not acting, they are falling behind. They watch price move without them and feel left out, as if the market is leaving them behind on purpose. That emotional response is not intuition. It is insecurity, and insecurity is what turns patience into pressure. Strategic waiting is not sitting idle with hope. It is standing guard with intention. It is knowing exactly what conditions must exist before action is justified and refusing everything else. That refusal is difficult because the market constantly offers temptation. Small movements, partial signals, almost sit-ups. These are not opportunities. They are tests. The market spends most of its time doing nothing meaningful. It moves, but it does not invite commitment. Traders who do not understand waiting confuse motion with meaning. They treat every fluctuation as information and every pause as urgency. That mindset guarantees overtrading and emotional fatigue. Waiting becomes painful when there is no plan. Without defined criteria, waiting turns into guessing. Guessing creates anxiety. Anxiety demands action. Strategic waiting removes that anxiety by giving the mind something solid to hold on to. You are not waiting because you are unsure. You are waiting because conditions are incomplete. The hardest part of waiting is psychological. It forces you to sit with uncertainty without trying to resolve it through action. Most people cannot tolerate that state. They want clarity now. They want confirmation now. They want relief now. So they trade prematurely and call it decisiveness. Professional traders wait more than they trade, not because they are slow, but because they are selective. They understand that acting less often improves decision quality. Fewer decisions mean fewer emotional errors. Fewer emotional errors mean capital preservation. Waiting also protects you after losses. Losses create urgency. Urgency destroys standards. Strategic waiting restores balance. It creates space between emotion and action. That space is where discipline lives. Many traders believe waiting means missing opportunity. In reality, waiting filters opportunity. It removes low-quality trades and leaves only those aligned with structure and probability. Missing bad trades is not a loss. It is an advantage. There is a specific feeling that accompanies correct waiting. It feels uncomfortable, quiet, and slightly frustrating. That feeling is the signal that you are doing it right. If waiting feels exciting, it is probably not disciplined. If waiting feels boring, it is probably necessary. Strategic waiting trains the mind to respect timing. It teaches you that the market does not need your participation to function. It teaches humility, and humility is essential for consistency. When waiting is mastered, trading becomes calmer, decisions feel cleaner, losses feel contained. Wins feel earned instead of lucky. The chaos fades because you are no longer foe. Seeing interaction, waiting is not the absence of action. It is the selection of the right moment, and in trading, selecting the right moment is more important than acting quickly. Those who cannot wait will always feel rushed. Those who can wait control the pace. And in a business where mistakes compound rapidly, controlling the pace is. A decisive edge, not noise, destroys discipline long before it destroys accounts. By the time money is gone, discipline has already been weakened quietly, trade by trade, decision by decision. Noise in the market is not just price movement. It is information overload. It is constant updates, opinions, alerts, indicators, lower time frame fluctuations, and unnecessary signals demanding attention. Noise creates urgency where none exists, and urgency is the enemy of discipline. When a trader is surrounded by noise, the mind never rests. Every movement feels important. Every candle feels like a message. Every pullback feels like danger. Discipline cannot survive in that environment because discipline requires clarity. Clarity requires space. Most traders do not lose discipline because they choose to. They lose it because they are overwhelmed. Too many inputs force too many decisions. Too many decisions drain mental energy. And when mental energy drops, impulse takes over. Noise shortens patience. It turns waiting into torture. It makes stillness feel irresponsible. Traders start acting not because conditions are right, but because the noise is unbearable. They trade to escape mental pressure, not to execute a plan. Lower time frames amplify noise. Small fluctuations feel dramatic when viewed too closely. Normal market behavior begins to look threatening. Discipline weakens because the trader is constantly reacting instead of observing. The market does not require constant monitoring. Traders choose that. And that choice comes with consequences. The more noise you allow in, the less control you retain. Noise also distorts perception. It makes random movement look meaningful. It makes weak setups feel urgent. It blurs the line between structure and chaos. And when perception is distorted, discipline feels impossible to maintain. A disciplined trader does not eliminate noise by force. He limits exposure to it by design. Fewer charts, fewer time frames, fewer inputs. Simplicity is not lack of sophistication. It is protection. The mind has limits. When those limits are exceeded, discipline collapses automatically. Traders often blame emotions, but emotions are the result, not the cause. Noise is the cause. Noise feeds fear and greed equally. Fear reacts to every pullback. Greed reacts to every expansion. Discipline requires ignoring both. That is difficult when noise keeps triggering emotional responses. Silence is where discipline grows. Silence allows perspective. Perspective restores patience. Patience reinforces rules. Rules protect capital. Noise breaks that chain. Most traders underestimate how damaging constant stimuli is. They believe staying informed gives them an edge. In reality, it keeps them reactive. Reactive behavior cannot coexist with disciplined execution. Removing noise does not reduce opportunity. It reveals it. When distractions are removed, true structure becomes visible. Decisions become fewer but clearer. Discipline becomes sustainable instead of forced. Noise makes trading feel urgent. Discipline makes trading feel deliberate. One leads to exhaustion. The other leads to consistency. Until noise is controlled, discipline will always feel fragile. And fragile discipline cannot survive long in the market. Survival comes before profit. And until a trader accepts that truth fully, every attempt at profitability will be fragile, temporary, and emotionally unstable. Most traders enter the market focused on making money. That focus seems logical, but it is backward. Profit is not the first requirement of trading. Survival is. Without survival, profit has no chance to exist. And yet, survival is the one thing most traders ignore. Survival means protecting capital. It means protecting mental clarity. It means staying in the game long enough to learn, adjust, and improve. Traders who chase profit first expose themselves to unnecessary risk. They trade too large. They trade too often. They trade when conditions are unclear. And when losses arrive, they arrive with force. The market does not remove traders because they are wrong once. It removes them because they cannot absorb being wrong. One loss should be manageable. A series of losses should be survivable. When they are not, something is broken in the approach, most catastrophic. Trading mistakes happen when survival is no longer the priority. After a drawdown, traders stop thinking about staying alive and start thinking about recovery. Recovery creates urgency. Urgency destroys selectivity. And selectivity is the foundation of survival. A trader who prioritizes survival thinks differently. He asks different questions. Not how much can I make, but how much can I lose without damage? Not how fast can I grow, but how long can I stay consistent? These questions are not exciting, but they are powerful. Survival requires restraint. Smaller size, fewer trades, wider perspective, clear limits. These choices feel restrictive to traders who are emotionally attached to profit. But those same choices create stability. Many traders believe that being cautious limits opportunity. In reality, caution preserves opportunity. Capital preserved today is opportunity available tomorrow. Capital destroyed today ends all opportunity permanently. Survival also applies mentally. Emotional exhaustion destroys decision-making faster than financial loss. Overtrading, noise, and constant stress drain focus. When focus disappears, discipline follows. Survival means stepping back before damage compounds. The market will always offer another trade. It will never offer another account. That reality should guide every decision. Survey. Val-first traders accept that missing trades is part of the business. They accept slow growth. They accept boredom. They accept discomfort. What they do not accept is unnecessary risk. Profit comes as a byproduct of survival, not as a goal chased directly. Traders who survive long enough naturally refine their edge. Those who do not never get the chance. Survival is not fear. It is responsibility. Responsibility to capital. Responsibility to process. Responsibility to long-term consistency. Until survival becomes the primary objective, profit will remain unpredictable. But once survival is protected, profit has space to grow. The trader's mind is the real battlefield, not the chart. Not the market, not the news. Every outcome in trading is decided internally long before price ever moves. Most traders believe they are fighting the market. They are not. The market does nothing personal. It does not hunt stops. It does not punish individuals. It simply moves. The conflict exists entirely in the trader's mind. Fear, greed, impatience, ego, and the need to be right create more damage than any market condition ever could. The mind wants certainty. The market offers probability. That mismatch creates tension, and most traders try to resolve that tension by acting. They enter too early. They exit too late. They change rules mid-trade. They overtrade, not because the market forced them to, but because their mind could not tolerate uncertainty. Every trader has rules. Very few traders follow them consistently. That failure is not intellectual. It is psychological. In the heat of the moment, emotions override logic. The mind looks for relief, not correctness, and relief often comes from action. Even when action is wrong, the trader's mind also lies convincingly. It justifies bad behavior with reasonable explanations. It says this setup is slightly different. It says this loss needs to be recovered. It says waiting is wasting time. These thoughts feel logical in the moment. They are not. They are emotional impulses wearing the mask of reasoning. Pain amplifies mental weakness. After losses, the mind becomes fragile. Confidence drops. Urgency rises. Discipline feels optional. This is where most damage occurs, not during calm conditions, but during emotional imbalance. Strong traders do not eliminate emotion. They manage it. They recognize emotional states early. They step away when clarity is gone. They do not trust decisions made under pressure. They understand that protecting the mind is as important as protecting capital. The mind is trained through repetition. Every disciplined decision strengthens control. Every impulsive decision weakens it. This happens slowly and quietly. Traders often do not notice the damage until it is severe. The market tests the mind constantly. It tests patience through waiting. It tests discipline through temptation. It tests humility through loss. It tests ego through success. Those tests never stop. Most traders fail because They try to control the market instead of mastering themselves. The moment you stop fighting price and start managing behavior, trading changes, stress decreases, decisions slow down, consistency becomes possible. The trader who wins long-term is not smarter, he is steadier. He does not react to every fluctuation. He does not seek excitement. He does not need constant validation. He focuses on process, not outcome. The real edge in trading is not information. It is emotional regulation, the ability to stay calm when uncertain, the ability to do nothing when nothing is required, the ability to follow rules when breaking them feels easier. Until the mind is mastered, no strategy will hold. No system will save you. No market condition will feel fair. The market is not the enemy. The trader's uncontrolled mind is.